Stocks slightly mixed to kick off what's a typically weak stretch for the market, but our next guest says history suggests the current setup bodes well for a return to all-time highs by year's end. Let's bring in Carson Group Chief Market Strategist Ryan Detrick. Ryan, good to catch up with you. We were here the 1st of August, so a month ago. You had been bullish. You mentioned that maybe August was going to be a little bit bumpy. What is the tendencies and the market behavior itself telling you about what we might expect in September?
Yeah, Mike, I'm happy 1 month since we got to talk. You're right. It was August 1st, and we talked about then the idea of up 17.5% for the year. Historically, August, Mike, had been down the last 4 times. So maybe it was time for some bumpiness. Well, this was the 5th time. But here's the kicker, Mike. When you're up 17.5%, again, the first 7 months of the year, August usually bad, September, this terrible month we've been hearing about, is actually higher the last 4 times with some really good returns. One more on this, when you're up 10% for the year and down in August, like we are right now heading into September. The S&P has been higher 8 out of 10 times with some really strong returns. We're not ignoring the seasonal weakness. We are saying, you know what, there's a setup. Maybe we can have a surprise September rally when no one expects it.
Right. And it definitely seems as if a strong start to the year does change the equation on what might be to come. That being said, aside from the seasonal patterns, what are you seeing in the market setup right now that makes you lean one way or another about how the year might finish?
Yeah, well, obviously, we've been overweight equities all year, right? People didn't like that call beginning of the year. They've come on a little bit. I'll tell you what, Mike, what I like is just look at like the internals, right? Advanced decline lines, the advanced decline line on the S&P 500. It's really strong. It's not that far away from an all-time high. So you hear about the Magnificent Seven, things like that. There really are a lot of stocks participating. The other thing, kind of the second part to this, I love to look at the credit markets, right? Look at triple B spreads, look at high yield drastically outperforming treasuries and investment grade. Keep this simple. If there's a monster under the bed, we would see more stress in credit markets. We had that 5% correction, last month, I guess now technically. We said the whole time it probably wouldn't be much more than that because the credit markets and the internals were both pretty strong. Just a little seasonal weakness, perfectly normal. Now we think that upward bias is back.
It is true. Credit markets never really sounded any alarms, although the absolute level of Treasury yield seems like it has acted as a little bit of a restraint on stocks. Once it gets to a certain level, how might that go from here? I mean, I'm of the view that the market can make its peace with different higher levels of yields if it's for the right reasons, but how does it play for you?
Yeah, I'm with you there. I mean, our opinion, the yields went higher last month because the economic data continued to get better. But I'll tell you, everybody kind of got on one side. Now you've got this economic data, this softening. I know you guys have talked about it all day. We're seeing some softening. Now yields, I don't know if yields have peaked for the year, but I think they drastically aren't going to keep going up as much as they were. And that can, like you said, kind of give the market its peace and let it kind of continue to rally. And let's not forget, though, September, October can be a little rough. But again, later in a pre-election year, November, December are really strong. So we still think new highs are quite likely, Mike, when all is said and done.
What parts of the market seem like they're standing out to you at this point?
Yeah, we've liked cyclicals and cyclical value a lot. I mean, energy, no one's really talking about energy. I think I talked to you a month ago. Energy is where it was like in 2008, Mike, okay? But yet energy all of a sudden is outperforming. So there's a lot of potential upside to energy here. We also like small caps. I know they haven't done as well last month. Look at how they're doing today. Small caps doing well. So if there's no recession, we think small caps and, again, those cyclicals, energy, industrials, materials, maybe a bit of financials will probably be the areas to lead, I guess we'll say, the rest of this year.
All right, Ryan, appreciate it. We'll hold you to it. Catch up with you again soon.
Thank you.